If you look at a chart of the last 100 years of economic history, you will see a series of disasters. You will see the 90% stock market crash of 1929. You will see the stagflation of the 1970s, where stocks went nowhere for a decade. You will see the dot-com bubble, the 2008 financial crisis, and the pandemic shock of 2020. To the average person, these events look like chaos. They look like random acts of bad luck that destroy savings and ruin retirements. But to the students of financial history, these events are not random. They are rhythmic. They are the inevitable result of the debt cycle. And more importantly, there's a specific way to survive them. When we analyze the portfolios of the families that maintained their wealth through the 1930s, the 1970s, and 2008, we find a pattern. They were not lucky. They were positioned correctly. They did not hold the standard 60-40 portfolio of stocks and bonds. They held three specific positions that act as a shield against the destruction of fiat currency and the collapse of asset bubbles. Today, we are going to break down these three positions. We are going to look at the math behind why they survived every crisis in the last century. And we are going to explain why, as we approach the sovereign debt crisis of 2026 and 2027. These three positions are the only life raft left. To understand why you need these positions, you must first understand why the old advice is dead. For the last 40 years, financial advisors have told you to own stocks for growth and government bonds for safety. This worked because we were in a long-term debt cycle where interest rates were falling. When rates fall, stocks go up and bonds go up. Everyone looks like a genius, but we are now at the end of that cycle. Global debt is over $300 trillion. Interest payments are consuming the global economy. The government can no longer lower rates without causing inflation, and they can no longer raise rates without causing a depression. This is the checkmate scenario. In this environment, stocks and bonds fall together. We saw this in 2022. The safety net is gone. So, what replaces it? Position number 1. The inflation shield hard assets. The first position that has survived every currency crisis since the Roman Empire is hard assets, specifically gold and productive land. In 1929, the crisis was deflationary. The price of everything fell, but the price of gold was fixed by the government. In 1934, President Roosevelt revalued gold from $20 an ounce to $35 an ounce. Think about what that means. While the stock market was down 80% and real estate was down 50%, gold holders saw a 70% increase in their wealth overnight. They were the only people in America who got richer during the Great Depression. In the 1970s, the crisis was inflationary. The dollar lost half its value. Stocks were flat in nominal terms and down massive amounts in real terms. Bonds were certificates of confiscation. But gold went from $35 to $850. It went up 24 times. Oil went up 10 times. Farmland tripled. In 2008, during the banking collapse, gold initially sold off with everything else. And then it doubled over the next 3 years as the Federal Reserve printed money to save the system. Why does this happen? It happens because gold and hard assets are the inverse of confidence in government. When a crisis hits, the government has only one tool: the printing press. In 1933, they printed. In the 1970s, they printed. In 2008, they printed. In 2020, they printed. Every time they print, they debase the currency. They are stealing value from your savings account to pay their debts. Hard assets cannot be printed. There is no central bank of gold. There is no Federal Reserve of farmland. The supply is limited by physics, not by policy. Therefore, when the currency is diluted, the price of hard assets must rise to reflect the new amount of money in the system. This is not an investment for profit in the traditional sense. It is an investment for preservation. It is the position you hold to ensure that no matter what the politicians do, your labor is stored in a battery that does not leak energy. But gold is not enough. You cannot eat gold. You cannot live in gold. This brings us to the second part of the inflation shield: productive land. In the Weimar hyperinflation of 1923, the paper currency went to zero. Billions of marks could not buy a loaf of bread. But the farmers were rich. Why? Because they owned the source of the food. When the currency collapses, the economy moves back to the base layer of Maslow's hierarchy of needs. Food, energy, and shelter become the most valuable things on earth. Owning agricultural land, or owning energy royalties, or owning residential real estate that produces rental income, puts you on the right side of the transaction. You own the things that people must buy, regardless of the price. Position number 2. The deflation hedge: strategic cash. This is the most controversial position. In an era of high inflation, we are told that cash is trash. We are told that holding dollars is a guaranteed way to lose purchasing power. That is true over the long term. But over the short term, during a crisis, cash is the ultimate weapon. Let us look at 1929 again. The stock market crashed. Banks failed. Credit disappeared. In that environment, cash was king. If you had cash in 1932, you could buy a skyscraper in New York City for pennies on the dollar. You could buy the best companies in America for 3 times their earnings. The person who is fully invested in hard assets has wealth, but they have no liquidity. If the market crashes, they still own their gold and their land, but they cannot easily buy more. The person who holds a strategic position in cash specifically. Short-term United States Treasury bills has dry powder. When the liquidity crisis hits, when the refinancing wall of 2027 triggers a wave of bankruptcies, wealth is set, prices will crash. People will be forced to sell their homes, their stocks, and even their gold just to pay their bills. This is the moment of transfer. The wealthy survive crises because they have liquidity when no one else does. They step in and buy the distressed assets from the desperate sellers. Warren Buffett is currently holding over $300 billion in cash and short-term treasuries. He is not doing this because he loves the US dollar. He is doing this because he knows the crash is coming. He is waiting for the moment when he can deploy that cash to buy high-quality assets at a 50% discount. This is the barbell strategy. On one end of the barbell, you have your inflation shield, gold and hard assets. This protects you if the dollar collapses. On the other end of the barbell, you have your deflation hedge, cash and short-term bonds. This protects you if the asset markets collapse. You avoid the middle. You avoid the long-term bonds that get crushed by inflation. You avoid the speculative growth stocks that get crushed by deflation. You stay at the extremes. Position number 3. The debt hack: fixed-rate liabilities. The first 2 positions are about assets, what you own. The third position is about liabilities, what you owe. Most people think all debt is bad. They are taught that being debt-free is the ultimate financial goal. During normal times, this is good advice. But during a currency crisis, debt can be the greatest tool for wealth creation if it is structured correctly. We must look at the example of Hugo Stinnes in Weimar, Germany. We discussed him in a previous video, but his strategy is the perfect example of position number 3. Stinnes understood that the government was going to print money to pay its debts. He knew inflation was coming. So he borrowed as much money as he could. But he borrowed it at a fixed interest rate in the local currency. He used that borrowed money to buy hard assets, mines, ships, and factories. When hyperinflation hit, the value of his assets exploded upwards in price. But the value of his debt stayed the same. He paid off his massive loans with money that was worth less than the paper it was printed on. He effectively bought the German industrial base for free. This is the concept of shorting the currency. When you take out a 30-year fixed-rate mortgage to buy a house, you are shorting the dollar. You are betting that in 10 years, the dollars you use to pay the mortgage will be worth less than the dollars you borrowed today. In an inflationary crisis, the debtor wins and the creditor loses. The government is the biggest debtor in the world. They owe $36 trillion. Their entire strategy is to create inflation so they can pay back that debt with cheaper dollars. Position number 3 is simply aligning your interests with the government. If they are going to inflate away their debt, you should align yourself to inflate away your debt too. However, there is a massive warning here. This only works with fixed-rate, long-term debt attached to a productive asset. Credit card debt will destroy you because the interest rate floats. If rates go to 20%, your credit card rate goes to 30%. You will be crushed. Margin debt on stocks will destroy you because the asset can be liquidated by the broker. The only safe debt is a fixed-rate mortgage on real estate that you can afford to service even in a recession. If you have a 3% mortgage on your home and inflation goes to 10%, the bank is paying you to live in your house. That mortgage is an asset, not a liability. So, how do you combine these 3 positions into a coherent strategy for 2026? You do not need to be a billionaire to do this. You can scale this strategy to any portfolio size. Step 1. The foundation. Secure your inflation shield. Aim to have 10 to 20% of your net worth in hard assets that are outside the banking system. Physical gold and silver are the most accessible. If you have more capital, look at energy stocks, mining companies, or direct ownership of land. This is your insurance policy. If the politicians destroy the currency, this portion of your portfolio will ensure you do not go to zero. Step 2. The war chest. Build your deflation hedge. Do not be fully invested. Keep a significant portion, perhaps 20 to 30% in short-term U.S. Treasury bills or high-yield savings accounts. This is your opportunity fund. When the commercial real estate market crashes in 2026, or when the stock market panics, you will use this cash to buy quality assets. You must have the discipline to hold this cash while everyone else is getting FOMO during the market rallies. You are not trying to maximize yield today. You are maximizing optionality for tomorrow. Step 3. The leverage. Evaluate your debt. If you have high interest, floating rate debt credit cards, auto loans, pay it off immediately. That debt is a cancer in a crisis. But if you have low interest, fixed-rate debt, a mortgage, do not rush to pay it off. Let inflation erode the value of that loan. Invest your extra cash into your war chest or your inflation shield instead. This 3-part portfolio is robust. If we get high inflation, your gold and fixed-rate debt win. If we get a deflationary crash, your cash wins. If we get a muddle-through scenario, your real assets and cash flow keep you afloat. This is how the wealthy survived 1929. They had cash to buy the bottom. This is how they survived the 1970s. They owned gold and real estate. This is how they survived 2008. They bought distressed assets. The crisis that is coming in 2026 is unique because it combines elements of all 3. We have the debt levels of 1929, the inflation potential of the 1970s, and the banking fragility of 2008. This is why the all-weather approach of these 3 positions is so critical. You cannot predict exactly which path the crisis will take, fire or ISO. You must be positioned for both. The greatest mistake you can make right now is passivity. The greatest mistake is leaving your money in a default 401k fund that owns the S&P 500 and long-term government bonds. That portfolio is designed for a world that no longer exists. That portfolio assumes that bonds cushion stocks. But mathematically, we know that when inflation is the problem, bonds and stocks fall together. That portfolio is a trap. You have to take active control. You have to become your own central bank. A central bank holds gold. It holds foreign currencies cash, and it manages its balance sheet debt. You must do the same. History is a harsh teacher. It shows us that wealth is rarely destroyed. It is merely transferred. It is transferred from the passive to the active, from the unprepared to the prepared, from those who trust the paper to those who trust the math. We are currently in stage 3 of the 6-stage debt cycle. The interest payments are consuming the growth. The political pressure for a reset is building. The event is getting closer. You have a window of time to rotate your positions. You can move out of the vulnerable assets and into the survival positions. Do not wait for the headlines to tell you it has started. By the time it is on the news, the transfer has already happened. The gates will be closed. The gold will be unavailable. The credit markets will be frozen. The time to build your ark is before the rain starts. If this breakdown of the survivor's portfolio has given you a clear roadmap, please subscribe to the channel. We are going to continue analyzing the specific assets within these categories. In our next video, we are going to do a deep dive into the cash component. Specifically, we will look at which currencies are the safest to hold when the US dollar wobbles, and how to buy short-term treasuries directly so you do not have counterparty risk with a bank. The storm is coming. But for those who are positioned correctly, it is not a disaster. It is the opportunity of a lifetime. Stay disciplined, stay hedged, and watch the cycle.